Good. I believe you can hear. Please confirm you can hear Mr. Kennedy. Hello, hear me, please. Kennedy, are you there? If you are there, then please hear me. Can you please? I'm trying to see it's not going through. Can you drop chat if you hear me? So should I like or you Hello, Mr. Kennedy.
Hello, sir.
Hello, can you hear me, sir?
I can hear you, but it is breaking.
Okay. Is it my network or your network? I think I have a good network here.
It is raining here. Maybe it's my network.
Oh, I see. Probably it's your network because it's raining over there. Because here is perfect.
It is raining here. Maybe it's my network.
Okay, sir.
You
Okay,
can
so
go
I'll
ahead.
try to take it slow. Okay, I'd like to take it slowly so that you can be able to listen there.
Okay.
Okay, thank you.
Thank you, sir.
Okay, so today we shall be talking about cash flow statement. We shall be talking about the cash flow statement, which have to be the last topic for your slab. Happen to be the last for slab. I the cash flow. I can start into as what I've done to understand that we have done a lot within this short period of time. Okay, after all that, Okay, welcome back. Welcome to Tope. We are just starting the class. I'm Mr. Kende. I apologize for the network issues that occurred earlier on. Okay, let's continue. Like I was saying, that this topic is the last topic in your syllabus, and we are trying as much as possible to that we have done a lot of things within a short period of time. You have covered, we have started from the scratch type of businesses, and we have done the rules, the golden rules, and what we know as gap. We have done the accounting processes. We know what we know. We have talked about standard IAS 1. We have talked about IAS 2. We have talked about IAS 8. We have talked about IAS 16. Now this is IAS 7 that we are not talking about. So we are on 5 standard in your syllabus. At the same time, we have touched other type of account, which means the sole proprietorship account, the partnership account, the company's account. So within that light, you agree with me that part of the content of financial statement is the statement of cash flow. It means that this statement of the cash flow is actually statutory by the company, that is mandatory by the company to prepare it. Now, when I'm talking about statement of cash flow, statement means what? It means the report. Cash flow, it means how money comes in and how it goes out. So cash flow is talking about the inflow and the outflow of cash. So there's a standard that have been set up by the board that is to govern the way the statement is being prepared. And that standard is known as IAS 7, statement of cash flow. The objective of this standard is actually to provide information about the historical changes in cash and cash equivalent of the entity. Every organization, either private or government owned, either partnership or proprietorship, they make use of cash. And cash can only flow in 2 ways. It can either flow inward or it flows outward. So we call it inflow and outflow. Those are the 2 ways in which cash can flow. An inflow is positive to the organization, while an outflow is a negative to the organization. Okay, now I mentioned that the objective of this standard is to make our information available to show the changes in a cash and cash equivalent of an entity. There's a difference between cash and cash equivalent. As we go further into the class, you'll be able to understand the difference and differentiate the two. Okay, so what are the purpose? What are the purpose for IAS 7? The purpose for IAS 7 is number one, is that the cash flow of an entity during the reporting period are the information are being provided. It means the information that the entity needs regarding to inflow and outflow are being provided for them to use. And they can either use it for decision making, for control purposes, or for other purposes. Also, it is provide information about the changes in cash and cash equivalent. So it provides changes in cash and cash equivalent. It means that at the beginning of the year, what is the cash that I have? Then at the end of the year, what is the cash I have? So what if there's an increase, what led to the increase? If there's a decrease, what led to the decrease? These are the purpose why we have the standard. This is the purpose why we have the standard. Okay, so what are the benefits for this standard? Let's look at the benefit for this standard according to IAS 7. One of the benefits of IAS 7 is that a statement of cash flow provide information that help users to evaluate changes in the net asset of an entity, and it is its financial structure. It makes you to know if you are liquid or solvent at a particular point in time. It helps you to know how your net asset move over time, because your cash and cash equivalent balances compared to the beginning tells you if you have actually increased in cash or not. You know, an organization can be making profit over time, can be declaring profits, and they will be struggling they will not be doing well in their operating activities, because if they are declaring profit and the profit, you have a lot of receivables, it means there won't be enough money for you to run your businesses. And if you have a lot of receivables, that means that your payables might probably also increase. Then you won't be able to meet your obligation as when due. But if you prepare your cash will help you to state how you have able to generate cash during the year, and as it has changed or affected your net asset. It also helps you to tell how you have structured your finances. Your finances, either maybe you added more debt or you added more equity. Is it that the owners brought in more money, or they went outside to get more finances to run the business? At a glance, it allows you to understand how your businesses have changed within a space of a year. The second benefit is that it helps users of account to compare the performance of different entities, because unlike profits, comparison of cash flow are not affected by the different accounting policy used by different entities. Now, cash flow statement is prepared basically on what? On cash basis. The basis used to prepare is cash. Anything that is not cash, that does not relate to the movement of cash, will not be found inside your cash flow statement. So, for example, it allows us to now compare two companies together, because company A might choose different policy from company B, even though they are in the same industry. If company A decides to go with weighted average and company B decides to go with FIFO method of valuing their stock valuation will be different. And comparing these two together might not give you a perfect situation, a scenario. Another one also, depreciation method also might be different. If the depreciation method also is different, it means that it will surely affect the profit. The way you treat your other transaction also in your profit or loss account can be different from company A, might be different from company A and company B. So cash flow statement it removes that called the differences in accounting policy of each company, because mostly what is used is what is cash basis. So it allows easy comparison between one company and the other under the same industry. Another benefit is that it is useful in assessing the ability of the entity to generate cash and cash equivalent. Because when you prepare your cash statement and you prepare it against the previous years, it helps you to tell the trend of how your cash are increasing or decreasing, and helps you to analyze the activities that's actually leading to the growth or the decline of your cash and cash equivalents. Another one also, it provides information that help users to assess the ability of the entity to affect what? To affect the amount and timing of cash flow in order to adapt to changes, circumstances, and unexpected opportunities. This is what we have explained earlier, is that it helps us to know how liquid we are and how solvent we are. It helps us to know that if we are going to be able to meet our financial dues as when due. Because your declaring profit over time does not mean that you are actually you have the cash to run your business. So whenever you are preparing it and your cash keep decreasing over time, your cash and cash equivalent percentage kept declining over time, it means that is a sign that probably over trading. It means that you are doing more than your capacity, and if you continue in that way, there will not be available of cash for you to trade. Because if I make 100% credit sales, my 100% credit sales will increase my profit because I've made the sales. So surely my profit will increase. But I don't have the money. If I don't have the money, that's I'm doing what? I'm doing more than my what? I'm doing more than myself. So it means that it might actually collapse the business. When the vendor begin to ask for their money, I will not be able to what, to pay them because I have overtraded. Another one also is that what, I'll just brief, I'll mention two more on the benefit of statement of cash flow, then I'll move forward. So another one that we have is to know the liquidity position of the entity. I've explained that. Also for investment and divestment decision, to know your investment. What is the interest coming on your investment? Okay, what are the areas in which you can divert into? If you have excess, if your cash and cash equivalent is increasing, okay, where this excess cash, where can we take them into to generate more interest and more income to the organization? It helps us also to assist us to meet our daily obligations, because some people statement of cash flow is prepared on a monthly basis. Some people even prepare it on a weekly basis. So they call it like, oh, cash flow. So they prepare on a monthly basis just to know that, okay, this is the money that we are expecting this week. This is the, okay, for example, now we are in this week, we just finished this week, and organization will have prepared a cash flow for next week. Okay, looking at, okay, our customers are owing us. What is the probability that they're going to pay us next week? Let's say it's 20%. Okay, what are the sales, cash sales that we can make next week? This is the cash sales that we are making, so fine. What are the expenses that we are likely going to incur next week? After we are aligned that, they will now look at the income, the projection for next week, and they will now look against the expense for next week. So that the reason why they are doing this is that they want to know if they are liquid enough, if they have enough cash to meet their expenses next week in order to meet their targets. In order to meet their targets. So statement of cash flow statement is a statement of cash flow is actually very, very important and what and good for decision and company review. Okay. The next one that we're going to look at is the sources and uses of cash. Sources and uses of cash. Now, when talking about sources and uses of cash, according to IAS 7, it requires that what? Their sources and uses of cash can be divided into three activities. It can be divided into three activities. And what we call the what? The operating and the operating activities, financing activities, and investing activities. But the way it is arranged on the standard is operating activities 1, investing activities 2, then financing activities 3. You need to know these activities because when you are preparing your statement of cash flow, your activities or your transaction will be grouped under each activities. So understanding of what each activity is very key to you understand the statement of cash flow. What do we understand by operating activities? This represents the principal revenue producing activities of the entity and other activities that are not investing and what and financing activities. I will explain that. Operating activity, it means that the main reason why the organization was set up is actually what the key principle, the key reason why they are set up. Any activities carried out on that basis is regarded as operating activities. A manufacturing company that manufactures goods, any activities that relate to manufacturing of the goods is regarded to operating activities. Buying of what? Raw material, transforming from raw material to finished goods, sales, vendors, and all those activities are example of operating activities. Now, investing activities. Investing activity, this represents acquisition and disposal of long-term assets and other investments not included in cash equivalent. I will still explain the cash equivalent as we go forward in the class. For now, this is what we are talking about, that investment activities relate to the disposal or acquisition of long-term assets and under investment not included in cash equivalent. This area is taking out our sense. What we are directing our attention to the non-current asset, the disposal and the acquisition of non-current assets. We mentioned operating activities earlier. operating activities relates to the profit or loss, information that is present in the profit or loss account. Why the investing activities is relating to the information that is present under the long current asset, which is found under the statement of financial position. So when you dispose of an asset and you acquire a new asset, those transactions or can be what is recorded under the investing activities. Then the third activities that we have is the financing activities. Now, financing activities, it involves changes. It involves this is the activities that result in changes to the size and composition of the contributed equity and borrowings of the entity, of an entity. Financing, it means that where do you source for God? How do you get the fund to finance your operating activities, to fund your operating activities? You can either get debt or equity or use owner's money. So this money, any activities that relate to how you fund how you get the fund that you use to run your business is classified under financing activities. Loan, one. Secondly, also another one also is what the other example that we have there is debt, debentures, dividend paid. They are the example of financing activities. Introduction of capital by the owners, absorption of what new people, new debts, and the rest. That example of investing financing activities. And the loan I mentioned there is the long-term loan. Long-term loan. Long-term loan is found under where? Financing activity. It means that I obtain loan to carry out my operating activity, my key purpose of existing. So I operate loan. It means the loan I obtain is a way to finance my business. And that's why it derives its name as what? Financing activities. Okay, after that being said, definitions of terms. I've mentioned cash and cash equivalent all the while. So let's try now to differentiate between the cash and cash equivalent. So this, we're talking about 1.4, which is what? Definition of terms. Definition of terms. Cash. What do you understand by cash? Cash in hand and cash deposit. That's cash. The cash that you have and the cash you deposit in bank. These are the words. Anytime you hear the word cash, that's what we call cash. Cash number one, cash in hand, your petty cash, your office cash, your bank, your demand deposit. These are example of cash. It means that they are in what? They are in the cash form. They are in the cash form. Now, what is cash equivalent? Cash equivalent is actually what? It is a short-term, highly liquid investment that are readily what? Convertible to no amount of cash and which are subject to an insignificant risk of changes in value. What I'm talking about is cash equivalent means that it is easily convertible to cash within a short period of time. It does not involve risk, or the risk is very, very, very insignificant. Example of them is what we call the government security. Government security is zero risk. It means that at any time, anytime you need your money, you can easily trade that instrument on the market and you obtain your money. Or even though you owed it, it is what? It is a guarantee that the government will pay you back the amount that is due to you. That's an example of what? Of cash equivalent that are easily convertible to cash. Inventory is not cash equivalent because inventory, there's already that inventory can take 3 months, 4 months, 5 months in your what? In your store before you dispose them. There's another version that says that cash equivalents can also be regarded as any inventory current asset that can easily convertible to cash within a space of 3 months. But it now depends on the industry. It depends on the industry. Okay? Now, cash and cash equivalent should have a short maturity period of, say, 3 months or less from the date of acquisition, since they are held for short-term cash commitment rather than investment purpose. What I explained, what I just finished explaining. 3 months. If you can easily convert it to 3 months, then you are good to go. That's why they say that whenever an accountant, as an accountant, your job is not just to prepare the financial statement. Your job is what? To serve. You are in the position as a consultant to advise the company on how to use or how to utilize their fund in an appropriate manner. So as an accountant, if you notice that there's always a particular amount of money in excess of what you need over time, then you can advise the company to invest the excess amount into short-term investment. That means it will be easily convertible to cash within a space of 1 or 3 months. Treasury bill is another example. Okay, is it treasury bill or treasury certificates? Okay, because one of them is longer, while the other one is 30 days. Now, let's now mention an example of cash equivalent. Example of cash equivalent is short-term deposits, loan notes, bank deposit accounts, government security. They are what? They are very bank deposit accounts. You know that your money is in an account, you can easily obtain your money. Loan notes, if you give a note to your staff that is payable within 1 month or 2 months, a soft loan, or you give anybody just a soft loan of 1 month or 2 months, it's guaranteed that you're going to collect it because it's your staff. You remove it from the source. That is what we call cash equivalent. Okay. Now let's move forward with the class. Let's see. The other one that let's say format of statement of cash flow. Format of statement of cash flow. Now, before we move into the format of statement of cash flow, remember that I said earlier that the activities, which means the source of cash, can be either classified as inflow or outflow. And I said that if it's an inflow, it means it's a positive. If it's an outflow, it's negative. Then we now say we have 3 types of activities. We have the operating activities, investing activities, and financing activities. These are the headings that you will find under your statement of cash flow. These are the 3 headings that you will find under your statement of cash flow. Now, we have 2 methods of preparing cash flow. We have the direct method and indirect method. The direct method is talking about the what? It's talking about the to display on the statement where you are getting your money from and where exactly you are paying your money to. While indirect is talking about a work back of net profit. It means that the non-cash item that you have initially used to reduce your profit to be added back, and the one that you have used to increase your profit will be what? Will be deduct from it. Then you do your working capital. Okay, but these 2 methods, you can be asked. They have tested you. They have asked you before in a past question to treat your statement of cash flow using direct method, and also they have asked also that you treat statement of cash flow using the indirect method. Okay. Now, the direct and indirect method only affect operating activities. The investing and financing activities will not change irrespective of the method that you use. But the only activities that changes due to the method that you use is the operating activities. Okay? Okay. Now let's look at direct method. Let's pick direct method, then we move on to the indirect method. Remember, I said direct method is a method that is used to show where your cash receipt and your cash payment. It helps us to show your cash receipt and your cash payment. The direct method cash receipt from customer as inflow. Cash received from customer as inflow. That's profit, is an inflow to the organization, so it's positive. Cash paid to supplier as outflow. This cash paid to supplier as outflow is what? That will give us is negative because it's an outflow. His money is leaving the organization. That's an outflow. Another one we have is what? Is cash paid. So, and on behalf of employee as outflow, paying to your staff, salary payment, that's also an outflow. Cash paid, anytime you see the paid with the word paid, it means it's an outflow. Cash paid for other operating expenses as outflow, that's admin expenses and selling expenses and the rest. Then we have interest paid as outflow. Then we have income tax paid. The reason why we are putting income tax paid under the operating activity is because if we don't carry out the business, we will not be subject to tax. So the reason why we are subject to tax is because we are carrying out this type of business. So it's reasonable to put the income tax paid under the operating activities. Now, this we have seen this is actually what this is what you are expected to compute under the direct method. But the way you are saying it, it seems kind of clear and correct. But in the examination, it's not that straightforward. It's not that straightforward. Why is it not that straightforward? It's because your profit or loss account is prepared, your statement of financial position, statement of financial performance is prepared using accrual basis and not cash basis. It means that your total sales is not the actual amount that you have collected from your customer. There is element of credit sales involved in your cash sales. Now, if that is the case, it means that you must adjust some figures, you must do little calculation in order for you to know the actual cash that you have collected for that period that relate to your customer. And the same thing also applies to the rest. Income statement for income tax paid, for example. You remember when we are solving an example as well, I said that under the adjustment, that the amount that we paid, the amount that interest that the tax that is stated on our statement of financial performance, which is a income statement, is an estimate. It's not the actual tax that will be paid. So, excuse me. So, if that is clear, it means that what we are going to pay later might be higher or lesser. Then there must be adjustment. Then another question is not this. What is the total actual, the actual cash that I paid for? So let's look at the Okay, welcome back. Welcome back. Sorry about the network. I think it's not the network. I think it's my system that logged out from the network. Okay, so I was explaining the cash receipts from the customer. So this table is what I'm going to explain now. This table is what I want to explain. Now, cash, before you can know the cash receipt from a customer, you have to firstly ask the question, what is the trade receivables balance, the opening at the beginning of the period, beginning of the year? What is the trade receivables? Then you ask for the year, okay, what is my total sales for the year? My total sales for the year, I will add it to the trade receivables. Then I will now this one will now give me the total. If I add the trade receivables at the beginning of the year plus the cash for the total sales for the year, it's going to give me my total amount owned by the receivables. It means that I've assumed that even my sales, my total sales is what is based on credit. My trade receivables is credit sales. Then I've assumed that my sales for the year is credit as well. So I'm going to add it up to now give me the total receivables owned. Then after that, I will now less my trade receivables at the end of the year. If I less my trade receivable at the end of the year, it means it now give me, it's now give me the total cash that I've collected for the year. Let's give an illustration. I run a company and I'm into maybe sales of phone. Okay. So Opetobi gadgets. And after that, I've sold some phones out and they are yet to pay me my money. So the total amount of money is 200,000. Okay. Now, that's the credit. Then for the year, I make a sales of 1 million. That 1 million, I have some credit items inside and I have some cash item inside. But I can't, it's kind of tedious for me to find out. So I was okay, fine. If that's the case, 200 plus 1 million, it will give me 1.2. It means that the total amount of money that I'm expected to have in my account, everything being equal, at the end of the year is 1.2, which is 1,200,000. At the end of the year, and I look at who are the people that are owing money. And I find out that 500, I still have 500,000 naira outside. Are you following me? I have to say, oh, what I'm expected to collect is 1.2. But at the end of the year, I noticed that I still have 500,000 naira outside. And that 500,000 naira is my trade receivables closing balance, which means the trade receivable balance at the end of the period. So if I remove my 500,000, which means that the one that I've not collected, from the one I'm expecting 1.2, the total amount is 1.2, the balance will give me the total cash that I've received for the year, which is what? Which is going to be 700,000. It means that the balancing figure of what? The difference between the total amount owned by the receivables minus the trade receivable amount at the end of the year is what we are going to display under our cash receipt from customer as inflow in our statement of cash flow under operating activities. So I believe that is clear. If you have any question, please, you can use the chat box. Anytime I see a chat box, I will surely round up. If I'm in the middle of explanation, I will round it up so I can attend to the question. Okay. So please, if you don't understand any, just let me know. Okay. Now that we have established the cash, now that we have established the what we call the cash receipt from customer, the inflow from customer. Then the other thing that we need to establish is what is the cash paid to suppliers. Cash paid to the suppliers. Who are the suppliers? Our suppliers are the vendors. Our suppliers are the vendors. So what is the amount paid to them? What is the amount paid to them? Before you can calculate the amount paid to them, the first thing that you need to calculate is your purchases. The first thing that you need to calculate is what? Is your purchases. So how do you calculate your purchases? You calculate your purchases using your cost of sales. How do we derive our cost of sales? We derive our cost of sales by saying opening stock plus purchases minus closing stock. So we work from known to the unknown. Now, in the exam, if they didn't give you purchases, it means that you need to determine your purchases before you can determine the cash that you pay to your supplier for that period. Okay. So how do we calculate our purchases? We use a figure known to calculate the unknown figure. So with opening stock plus cost of sales minus closing stock will give us our purchase. That is what we call subject of the formula. Normally, what we have there is cost of sales. Cost of sales equals what? It equals opening stock plus purchases minus closing stock. Everything be equal. That means that if there's no additional information that relates to it, like return inward or return outward, carriage inward and the likes. Now, this is what we know. But we are not giving the purchases, but they give us cost of sales. So the next thing for us is now to make the purchases subject of the formula. So we have purchases. You carry the purchase to the left-hand side. Carry your purchase to the left-hand side. Then you put equal sign. You know, because okay, let me just do a small mathematics here. Now, if you carry your purchase there, it's going to be minus purchases because the purchases is positive. But once you take it to the other side, it will be minus. Now, if that is the case, next thing you now have is what? We have the opening stock minus closing stock, which means they are still there, they are still at their end. Then you are bringing down the cost of sales minus cost of sales. Since you are looking for positive purchase and not negative purchase, then you can multiply everything by what? By negative. If you multiply all by negative, you will now have purchases, that's minus times minus is plus, equals opening stock order will now be minus opening stock plus closing stock plus cost of sales. Okay, is that correct? Well, I done correct. Opening stock. Okay, so let's collect the light times. So cost of sales equals opening stock plus purchases minus closing stock. So now taking the purchases down here, it will make, okay, so it will now be opening stock. Okay, or is that purchases equals minus purchases equals opening stock minus closing stock minus cost of sales. So everything together. So if you now, after that, we can now write it as what? Purchases equals cost of sales minus opening stock plus opening stock plus closing stock. So that's it. So we are good to go. Let's just do an illustration. If our cost of sales, let's do an illustration. Let's say, assuming that our cost of sales equals, let's put it to be 25. Our opening stock, let's start with opening stock. Sorry, let's start with opening stock. opening stock, I'm just trying to form a question here. Opening stock equals, let's call it 20. Our purchases for the year, our purchase for the year equals, let's call that 10. Then we have a closing stock to be 5. Then it means that our cost of sales will now equals opening stock, which is 20, plus purchases, which is 10, minus what? Closing stock, which is 5. And that will give us the total sum of, that's 20 plus 10 is 30. 30 minus 5 is what? 25. So we have that to be 25. Now, assuming that we do have what? Purchases, and we are asked to calculate purchases. So let's use the formula that we have derived. Purchases equals, so we have closing stock. What is our closing stock? 25. Then what again we have? Opening stock, which is what? 20. That's, and then we now have plus what? Plus our closing stock, which is 5. Then if we have that to the 5, that will give us a total sum of what? That's 25 minus 20 will give us 5. 5 plus 5 will give us 10. And we have our what? We have our closing purchases in the beginning to what? To be 10. To be 10. I believe that is clear. I believe that is clear. Okay. I believe that is clear. Now, let's ignore these. If we use this formula, which is opening, okay. I'm trying to look at the formula given earlier. The formula given earlier should not be that. Let's create that. Which should be minus. Which should be plus. So let's try that. Opening stock is 20. 20 minus what is cost of sales? 25. Please just use your, so just do the subject of formula. I'm trying to work around the formula given earlier on using the same illustration. So just work around the formula, please. The one so I will just delete this. Okay. So use the formula to derive your purchases. So when you derive your purchases, then you can now move to the what? To the table below. So you can move to the table below. What is the table below? The table below is now talking about you start with what we call trade payables. You know, under the cash received, we started with what? Trade receivables, because it relates to our collection of what? Of money. But under this cash paid to vendors, we are going to start with trade payables. Trade payables, or is formerly known as what we call the supplier account, or what we call the creditors account. So the beginning of the year, look what is your total trade payables. After that, you add your purchases. Either it is cash purchase or what? Or credit purchase. You add everything together. Then you now less it. Then you reduce it with your closing balance of your what? Trade payable at the end of the year. The balance figure will now show you the balancing figure will show you the total amount of money that you have paid for purchase within the period. It will show the total amount of money that you have paid for what? Within the period. That's what we call payment. That's how we derive for payment to suppliers. So another one also we have for salaries as well. The same principles applies to the salaries or wages and salaries as well. So we look at the accrued wages and salary at the beginning of the year. So what is the total amount of money that we are owing these people that we have not paid them? Because remember, we are using cash basis and not accrual basis to prepare the statement of cash flow. So you look at, okay, now what is the payment of wages and salary? The accrued, which means the one that we are owing them. Then after that, you look at the total. You look at the total wages and salary that has been owned. When you now look at the total wages and salary that you expect to pay the employee for the year, you add it to the opening balance. When you add it to the opening balance, you now use it what you less it. You use the accrual wages and salary at the end of the period to reduce that total amount of the amount given to you, which is the total wages and salary owed to the employee. Okay, so the same thing also applies to the what? The same thing also applies to other cash paid can be calculated as follows. Other cash paid as well, which is what the admin cost to be added, the distribution cost to be added, the other operational cost to be added. After you have that, they will now start reducing. You now start what? You start that lessening some transaction that does not involve cash flow, that does not involve movement of cash flow from this total amount of money that you have recognized earlier on. For example, under the administrative cost, there might be element of depreciation inside it. And once there's element of depreciation inside it, depreciation does not involve movement of cash. Does not movement of cash. So we need to what? We need to remove the element of the depreciation from the administrative cost. If it's amortization as well, or impairment loss, now impairment loss of assets, disposal, either gain, all these things must be removed. The only thing that is expected to be under your cash flow statement is the item that relates to the movement of cash. Then also the same thing also apply to the interest paid. Interest paid might be different from interest charged in the income statement. So you have to calculate the cash as well. So you start by using the accrued interest at the beginning of the year. After that, you add up the amount that is being charged with profit or loss. Then after that, you less the accrued interest, the amount that you are still owing at the end of the period. You use it to less the total interest owed for the year, so that you can get the total interest paid. So you can derive what the total interest paid. Okay. Now let's look at, so if we are able to do that, then it means that you have been able to do what we call the direct method. So direct method, like I said, direct method is trying as much as possible to establish where the money is actually coming from and where we spend the money that is relating to what? To the operating activities. Where its money is coming from and where it's going to as they relate to the operating activities. Okay. So the next method that we have is indirect method. Now, under this indirect method is different from the direct method. Indirect method means that instead of you displaying all this, since you have prepared your statement of financial position and statement of financial performance, so there's no need for you to state it all. What you just need to do is to go pick your net profit and adjust your net profit on non-cash movement. Then you do your work, your movement in working capital. This is what I'm explaining. If you look at here, we have so under the indirect method, we are going to start with the profit or loss before tax as inflow. So that's profit or loss before tax as inflow. In case you mistakenly pick profit or loss after tax, it means that you need to remove the element of tax there. But the appropriate thing to use is to use the profit or loss before tax. Now, once you pick that, you are going to get that information from your profit or loss account. You are going to get the information from your profit or loss account. So once you have that information, the next thing for you is to start adjusting. The next for you to do is now to start adjusting. So you start adjusting. The item that involve and remove it. Example of Okay, another network glitch. Mm. Okay, that's network. So let's continue. Like I said, okay. Sorry about that, please. Then I was actually explaining the adjustment. Then I've talked about the depreciation. Then I've talked about the amortization also. It does not involve movement of what is the paperwork. The other one that we have is lost on asset disposal. You know, when under the IS 16 that we talk about the asset, we talk about the disposal of asset. Now either you have loss or gain. And if it's loss, it's going to what reduce your profit. And if it's gain, it's going to increase your profit. So it's going to be found, it's going to be found under the it's going to be found under the statement of profit or loss account. So if that's the case, then it means that you need to adjust for the profit that you have ascertained at that moment. The other one also you have what increase in provision. Provision does not involve movement of cash. Provision is just what is the paperwork, does not involve movement of cash. So whenever there's an increase in provision, what you need to do is to what is to add increase in position. What does increase in position does is to reduce your it reduce it reduce it reduce your net profit. But if it's a decrease in provision, it means what it now be regarded as what as an income. Remember when I was explaining earlier on that I explained the treatment for doubtful debt as allowance for doubtful debt. I said that it's possible for you to see the doubtful debt figure under the credit side of the income under gross profit. And I said the reason is that if in the previous year they have actually made provision for 100 before, and the current year they are making provision of 80, it means that that 20 difference must be added back to the statement of financial position. And the way you can add it back to the statement of financial position is by what crediting the account to increase the gross profits. And that transaction can be named as decrease in provision, decrease in provision. So whenever there's an decrease in position, you minus it. Whenever there's an increase in position, you add it back. Now I'm explaining it so that you can just get the logic. And that one also have on disposal. Gain on disposal, you have to remove it because it had been initially added under your profit or loss account. So you have to remove it now under your cash flow so that you can actually have the actual profit that involve movement of cash item. The other one also that we have also is interest expenses. Interest expenses also should be taken out. Should be what? It should be added back. It was used to reduce before it added back. The reason why we're adding it back because that interest expenses is going to be under our financing activities. Because the reason why we are generating the interest is not because of the business, but the reason why we are generating the interest is because of the way we have decided to fund or to run or to source for funds to run the activities. So it's more appropriate to be found under the financing activities. But please, there are some tax rules that add it under the operating activity. That does not mean that what they are wrong, but because the IAS 7 actually what allows it. Okay. The other one that we have is movement. So after you have done the adjustment, after you have adjusted the net profit of the non cash flow item, the next thing that you need to do is now to calculate what we call the changes or the movement in what in your working capital. Changes or movement in working capital. What is working capital? Working capital is the difference between the current asset and the current liability. It's the amount that is available for the organization to use to run their day-to-day activities. So it's what current asset minus the current liability. So now, since the working capital involves the current asset and current liability, it means that we need to look at the differences there. If there are changes on those two, the changes also we need to be affected here. Example of what we're talking about is trade receivables. Trade receivables is a current asset. So how do you know at the beginning of the year my trade receivable is 100, at the end of the year my trade receivable is 150? There's a difference of what? Of 50. It has increased by what? By 50. So if it increased by 50, how do you know that it's an inflow or an outflow? That is where many students normally have an headache. So I do explain them to them this way, that since we are under the current asset, cash also is an example of current asset. Even though cash will not come under our workings, our movement in working capital, please, cash will not come. Anything cash equivalent will not be displayed under our changes of movement in working capital. So what I'm trying to explain is cash is just that if we have a cash at the beginning of the year to be 1,000, at the end of the year, you now have it to be 700. What have happened? It means that there have been an outflow of 300 from you. So that's what. So whenever you compare the beginning and the ending period of current asset and it reduces, then it means it's an outflow, which is negative. Sorry about that. I went to reposition the Wi-Fi, the MIFI, if it's actually the position that's making it cut, because the other end they are using it and it's fine. So I don't know why it's logging me out here. Okay, so let's continue. The changes. So we are on the current liability, and I said that let's put an example for current liability. Example of current liability in sense that, sorry, excuse me. If I'm a vendor, I'm owing my vendor 20,000 naira before at the beginning of the year. Then at the end of the year, I'm owing my vendor 40,000. What have happened? It have increased. An increase is an inflow. So it's positive for them. But if I'm owing my vendor 20,000 and at the end of the year, I'm owing my vendor 10,000, it means that I've paid how much? 10,000. So that 10,000 I've paid is an outflow to the organization. So it means that whenever there's a decrease in the current liability, it is negative. Well, whenever there's an increase, it is positive. The opposite appears under what? Under the current current asset. Current asset means that whenever there's an increase, it means there's what? Okay, let's say increase in current assets means it's not negative. Oh, increase in current assets will lead to cash outflow, while decrease in what? Decrease will lead to cash inflow. because when I was explaining that, I looked at, okay, increase in current asset will lead to what? An outflow. The reason why it's going to lead to an outflow, let me rephrase that, please. Pardon me for that. Okay, the reason why it's going to be an outflow is receivables. So receivables is that your receivables have increased over time. It means that the amount that you expect to receive, you're not receiving it, is going out. So if any time it increases, it means is what? It's an outflow. Then another one also, we also, okay. Liabilities, then the opposite is for the liabilities, which means that whenever there's an increase in liability, the word is positive, like the payables that I talked about. That's fine. I'm expected to pay 20,000, but at the end of the year, I'm owing you 30,000. It means I've collected extra of 10,000, so it's an inflow to me. But if there's a decrease, it means there's an outflow. Let's now use an inventory as an example as well. That inventory, I have inventory be 20,000 naira before. At the end of the year, I have it to be what? To be 40,000 naira. It means I've invested more into the inventory. An increase in the inventory now be an outflow to me, because at the beginning of the year, I have 20,000. At the end of the year, I have 40,000, which means I've purchased more inventory. And so far I've purchased more inventory, it means there's an outflow of that of cash that I used to purchase the inventory. But if there is actually what? A decrease is an inflow. It means that there's cash have come in. It means cash have come in. Please forget the scenario I use about cash. It's actually inventory will be more is better off than cash, because they're a little bit different there. So inventory means that whenever there's an my inventory start reducing, it means I'm making sales. And when I'm making my inventory start reducing, I'm collecting money. So a decrease in inventory leads to positive inflow. Leads to positive inflow for the organization. The same thing concerns receivables. At the beginning of the year, my receivables is at 200,000, but at the end of the year, my receivables is 150. It means I've collected 50,000 naira out of the money that is collectible before. So I have 20,000 beginning of the year. End of the year, I have 150. So it means I've collected 50,000 in between of the year, and that 50,000 will now be an inflow to my organization. It will be an inflow to my organization. So cash and cash equivalent will not be considered. Okay, this one, cash and cash equivalent will not be considered when calculating the movement in the working capital. It will not be considered when calculating the movement in the working capital. An example of the cash and capital that we have mentioned earlier is the cash, bank draft, the short term, the government security, the bank deposits. This will not be considered. The changes will not be considered because they are at their form. So there's no need to consider the beginning and the end. Now that we are done with the operating activities, because I've been able to explain the two methods now using I'm able to explain the two methods, which is the direct and indirect method. And I've said that the direct and indirect method only affect operating activities. So I've explained that I've explained the two methods under the operating activities. So the next one that we're going to move to is the cash flow from investing activities. So on that now, this includes both the inflow and outflow, but only those cash outflow that result in the recognition of assets and are eligible for classification as inventory. Any expenses that is capitalized that is under the non-current asset will be found under the investing activities. It means that you have invested, you have put your money into a particular business that will serve a return over time. That's why we said that non-current assets are assets that lose more than 12 months with financial year. It means that I've put money into this thing now. In the next and after 12 months, I will still be collecting interest or economical benefit from it. So that's what we call investment. And then if you remember under when we did the IAS 16, I said that non-current asset can be declassified into two, which is the tangible and non-tangible asset. The tangible asset are the assets that you can see, feel, and touch. Example are what we call the equipment, plant, and machineries. Then we have intangible assets. Intangible assets are not the assets that what they cannot be feel and touch, but they are the assets that have impact on an organization. That's what we call the what. That's where the amortization comes in on some of the assets. So investment as a investment, patent, copyright, and the rest. So there are what these are type of what another example of asset. So any or if we purchase a new asset, the total amount of money that you used to purchase the item, if it's cash, will be found under the investment activities. Now, if we dispose of an asset as well, it will also be what proceed. The proceed of that amount will be found under the investing activities. So let's go through the example, what the items that we can find under the investing activities. The first one we can find the other what cash paid to purchase non-current asset, PPE. Another one we have is what is the another one that we have is cash received from the deposit disposal of what of non-current asset. It means that the cash that we receive from disposing of our current this process proceed when disposed of our non-current asset. The sales proceed that we receive there is regarded under the investing activities. Also, cash paid to acquire a subsidiary as well. We know subsidiary that's an investment. We acquire a subsidiary is an investment on its own. So the cash that you pay to acquire the industry will be found under the cash that you pay to acquire a subsidiary will be found under the investing activity because you are investing. The reason why you are investing to that maybe you are purchasing shares in another company or you are buying more than 50% shares in another company. That's the example of what example of investment. Another one that we have is cash received from the sales of shares in a subsidiary. Like I said, cash received. So when because you have invested into it, it's like a dividend from that. So anything that comes from such investment will be regarded to what will be recorded under the statement investing activities. So we have interest received from investment. We have dividend received from inventory. All this income will be regarded to what under the investing activities. Okay, so cash paid to acquire no. So there are some little calculation that we what might be required to calculate before you can know what your changes in your PPE. Your PPE changes over time. So before you can know if there's a disposal or acquisition, sometimes they might not tell you. So you need to know. You need to know if there's actually what if your assets have grown. If your assets have grown over time, it means you have made purchase. And once you have made purchase, it means that you have spent cash. You have spent cash. So once you have spent cash, it means you need to reduce your cash and cash equivalent at the beginning of the year. So how do you understand that? Like I said, there might be cunning, there might not be straightforward. So the next first thing you have to do is what? The carrying amount at the beginning of the year. You have to identify the carrying amount at the beginning of the year. Once you identify the carrying amount at the beginning of the year, you now start adding and deducting any other information that relates to the asset. And example of what I'm talking about is, for example, I have an asset here. Okay, a group, an asset is based on group. PPE is group. So if I say machine, I'm not talking about one machines. I'm talking about all assets that we classify under machines added together to give me that figure. So if that's the case, I'm like, so fine. Did I ask, is there any new lease? If there's any new lease, that is also an asset. I'll add it to it. Okay, that's for example, we have two types of lease. We have the finance lease and operating lease. So if looking at fine, there's probability for me to work to retain this equipment, or if anything happened to it, I'm going to pay a larger amount of money in the interest. These are the under standard on its own that you're not expected to know. I'm just explaining in details. What I'm doing now is actually to give you the overall information that you need. That even though when you reach skills level, when you reach skill level and they are mentioning all these things, it will not be strange to you because you would have done more than what the more they even required for. So before I know if there's a purchase of what of an asset, number one, I'll start with what we call the carrying amount for the beginning of the year. After that, I will add up my lease for the year. If I have lease for the year, I will add it up. If there's what we call revaluation, if the asset value during the year, I will add the revaluation upward. But if it's downward, if the revaluation is downward, it means that I'm going to reduce my carrying amount by that figure. Then after that, I will look at my depreciation charge for the year. We started with carrying amount, not cost. So we can't put accumulated depreciation. So we now not put depreciation charge of the year because I will use it. So I'll charge, okay, this was it. I will not charge my depreciation for the year. I'll charge it against it. So it will reduce. Normally, it's going to reduce this, it reduce it normal. Then after that, what is again? I'm going to have my current amount of asset disposed. The asset that have been disposed of as well, we call the carrying amount. I'm going to obtain it. I'm going to use it to reduce the carrying amount of my opening figure. Then after that, also provisions. If there's any provisions on what? On the asset, I'm going to address that as well by what? By adding, by putting a provision reduce it. So since provision have reduced it, I need to add it back. Then at the same time, I will ask, okay, what is my carrying amount at the end of the year? Give the carrying amount at the end of the year will now be used to reduce the total, what you have added before. So what you now, when you reduce it, the difference there will not be the total asset that that they have purchased during the year. The total asset they have purchased during the year. Let's start as an illustration. Let's have as an illustration. Illustration, I was saying that at the beginning of the year, I have a motor vehicle of 1 million. Okay. And I have motor vehicle of 1 million. I dispose of a vehicle that worth 200,000, carrying an amount of 200,000. So it means that what I have 1 million before now, I've reduced by 200,000. I will reduce it, that will give me my 800,000. So at the end of the year, I'm not saying that I'm not having, my account is not showing motor vehicle to be 2 million. Can you see? I'm expecting 800,000, but it's showing 8 million. It means that there's element of I've purchased another vehicle that have not been accounted for. So if that's the case, I'm not saying what is the difference there. The 1 million minus 8, sorry, 1 million. That's my closing figure. And this one is what? This one is 800,000. So I'll not say what is the difference there. The difference there is the value of the asset that have been purchased during the year. The difference there is the value of the asset that have been purchased during the year. Then after that, we move to the cash received from deposit, asset disposed. When you receive cash from asset disposed as well, it's also, like I said earlier, it's going to be part of your work. It's going to be part of your investing activities item. So we look at the cost or the revaluation amount. After that, you less accumulated depreciation. Accumulated depreciation, when you are using cost, you less accumulated depreciation. The reason why you're doing that is to ascertain your carrying amount on the disposed account. So when you ascertain your carrying amount, the next thing that's for you to work, the profit or loss on disposal. You check the profit or loss on disposal, then you have your cash received from the assets disposed, because they might not give you the cost of the proceed. They might not give you the sales proceed. So if they didn't give you the sales proceed, this is the way you are going to do it. It means you are going to walk backward. I don't think they can ask you at this level, but I think I've seen that question before in professionals level, that they ask them backward to prepare the financial statement. They give them the end result. What they expect to do is now to walk backward before we can get our sales. For us to get our profit, our gain. What is the method? The method is just the sales proceed minus carrying amount equals my gain. For this time around, then I say, okay, fine, we are not giving you the sales proceed. We are giving you the gain. So how do you do it? So it means that the gain there will now be what you cost multiply it, just like what I did earlier on. Once you cost multiply it and make it subject to the formula, it's going to give you what you need. It's going to give you what you need to solve this equation. So let's look at, so that's what you do. Then another one that we need to look at also is what is the cash flow from financing activities. Cash flow from what we are doing tonight. I'm giving you a full explanation what you need to understand. Then next class we're going to we are going to solve questions. So what I'm doing right now is for you to understand. You need to be grounded in it. When you are grounded in it, then we can now we move on and to solution and solve from question. Please, its probability of them testing this is also there. I can't say it's high, but one thing about them, one thing about I kind of have noticed is that anytime they test what ISL with this diet, the probability of not testing in next diet is high. They will not test it again and in following diet. There's always like one more break diet in it. But I'm just saying this. I'm not an examiner. Neither am I giving you AOC. But I'm just trying to see that that's what I've observed in their questions. That's what I observed in their question. I think last time they didn't bring it out. So which means probably next one they can actually bring it out. Okay, so now let's go back to the what we are on. We are on the cash flow from financing activities. So when I'm talking about the cash flow from financing activities, so cash flow from financing activities, this is actually the amount that we derive from the business, from the okay. So cash from financing activities, it means that the how the company structured the organization, how they fund their operation. So everything that relates to the funding of operating activities comes under this heading, cash flow from financing activities. Now, cash flow from financing activities, an example of what you have is what is the cash proceed from issuing new shares as was inflow. You need money. You really release that more shares that people should subscribe to. When people subscribe to it, they pay money for it. When they pay money, is an inflow to the organization, so it's positive. And that way also is what cash proceeds from the new loan or issuing new bonds as inflow. So when you actually receive a long-time loan as well, is what is an inflow, is an inflow. But when you are paying the interest and the principal, it will be in an outflow. But when you receive the money first, you'll be happy, you'll be and you'll be jubilating that you have received the money that you're looking at, you have collected the money that you're looking for. But at the back of your mind, you should be registered that you're going to pay back the principal. At the same time, you're going to pay back the interest. So then anytime you're paying back the principal or the interest, it will also be found under the financing activities because it's the financing activities that collected the money in the initial place. So it's the financing activity also that will pay out that money. The other one that we have is what we call the share pay to redeem shares, cash pay to redeem shares or bond as flow, dividend paid when you paid any shareholders or any debentures holder interest. That also will be found under our financing activities because it's changing the way that we account for things. It's changing the way that we account for things. So dividend paid. Now, it's possible for you to see dividend paid and dividend received in the examination, or I think I've explained dividend received earlier. Dividend received is actually found under the investing activities because you only receive a dividend because you have invested. And since you have invested, your investing activities your investment is found under investing activities, and the proceed that comes from it also will be charged against what the financing activities. But when it comes to the dividend paid is the amount that the company is paying to its shareholders, and the shareholders are part of who that form the financing activities, which means that that dividend will be charged against the financing activities. Also, the same thing goes to the interest paid. Interest paid. Now, next we note some things here. There's a particular things that you need to note because once you note it, you are good to go. Because once you note it and you are getting issues or confused in one way or the other, it will help you and assist you to know what you should expect. It will help you to know what you should expect. So the one that we have here, we have what we call the we have sorry, let me just sorry. Okay. I think this is better. Okay, so what we need to know is dividend paid might be included as operating investment instead of what financing as cash flow. So there are some items that if you check some textbook, you find dividend paid under the word financing cash flow. There are on some people also penalize put it under what operating cash flow. Nobody will be penalized, but to me, I think it's more preferable for you to put it under the financing activities. Then we have interest paid might also the same thing also interest paid might also be included in the what in the operating activities as well. But they can also be included in the what in the financing activities. Please don't include it on the two. Know that if I check your solution, I will see dividend paid in your financing activities. I will see dividend paid again in the operating activities. No, it's not done. So you have to what? You have to make sure that those two right. So we have emphasis is much on equity and non-current liability items. So for financing aspect, emphasis is more on what? And equity and non-current liability item. So anything that is current liability is goes to the operating activities. So the differences go to the operating activities. Amount received from shares issued is calculated as opening shares balance plus bonus issued during the year minus closing balance of shares. The same method that we use to calculate the interest paid is the method that we are going to use to calculate the the amount of shares. So which means that okay, at the beginning of the year, what do we have at the end of the year? What is the total people that we have accrued into? What is the total money that are paid? So now, okay, what is the total money that is remain unpaid? Check it against the one that was repaid. So another one that we have is what also share premium can be adjusted by taking opening balance minus any bonus issued minus closing balance. Okay. Another one that we have is what there is inflow in loan notes if closing balance is more than operating balance and vice versa Where dividend paid, when dividend paid during the year is not given, retained earnings can be adjusted to reflect this. Okay, so these are just the adjustments we're talking about. So where dividend paid during the year is not given, retained earnings can be what can be used to adjust it, which means that when the dividend paid is not shown, you adjust on your retained earnings. You adjust on your retained earnings because retained earnings as a function of the previous profit that they have earned in the previous year, but they have plowed back to the organization to be used to develop or expand the business. So if there is dividend paid out, it means that dividend paid out is amount of the what of the profit or is a part of the profit that was brought back to the organization for use. So finance lease obligation is driven by adjusting liability at the beginning plus asset purchase on lease during the year minus liability at the end. That's which means the current and the non-current liability, which means the current and the non-current liability. So we have questions here. So we have sample question on cash flow. So what are the cash flow questions we have for cash flow? We have the Dynnet PLC. So I will not, I don't want to solve any question in this class. I just intend to explain it. So by next class, we'll solve question. That will be Monday by God's grace. So by Monday, we'll be solving question. But before we call it a day, I want to know if you have any questions so far. Please, we want to have a question. Can you please drop it on the chat? I will go through the chat and add it up. Any question? Please ask question. So I'm waiting for questions. Any questions so far? Any question? Any question? Any question, please? Okay. As before like I said, I promise you a class of objective. Then we're gonna talk about the objective because your questions is not just theory alone. Objective is part of it. So I promise you a part, like I said, maybe 1 or 2 diets. We're going to review together and see how we can save time on objective and move on. If it's possible for you to get 20 in objective, but you can only get 20 objective and you have 18, you are good to go. 18 in your pocket in ICANN exam is more than enough. So you have 18, then you can also now look for forward ways to get additional mark. So any question for on cash flow before you call it in day? Also, I'll give 2 minutes. If there's no question on cash flow, we call it a day. Or if you have any question also that does not even relate to cash flow, that relate to our past classes, or lost so just send me a chat and I will answer you. And as I've noticed that you guys don't submit your assignments, you don't ask questions other than the assignment like assignment. It's possible. Like I can have said that the student should be paying right now because it's possible that at any point in time they will announce the exam date because the secondary schools are trying to open up now. And once the secondary schools open up, there's no reason why I will not hold the exam. So it's possible. So I'll plead with you right now that I should start reading. Forget about that maybe they are not giving you the date. Forget about the date now. I'll implore you to start reading seriously as if tomorrow is the exam. The beauty of this is to write it once and pass. I'm telling you, if you write it and you pass, it's good to go. If you have written it before, that's not the end of this. The end of it, it allows you are here to learn more. You are in here to know it better. That's why. So if once you know it better, you are good to go. You are good to go. So few seconds more for the questions. If there's no, few seconds more for the question. Few questions for the question. I allow you, don't worry, you can unmute yourself. If we are kind of, you don't want to, you can unmute yourself. So let's see. So you can use the mic. Because if I start any solution, any question now, I won't be able to solve. I won't be able to end it before the time ends. I don't want to be. So I don't like half solved question. So I like that you start it and you finish it. So if you have anybody, so you can unmute your mic yourself, please. Valadi. Okay, so
Hello, sir.
yes, sir, Mr. Kennedy, I can hear you.
Yeah, no question actually.
Okay, sir.
I'm still, though it's not that the way I was following the way you are explaining.
Okay, sir. Okay, sir. Thank
But
you.
maybe when we solve questions, we I may actually ask questions.
Okay.
But
Okay.
no question yet.
Okay, I think what I'm going to do is, by God's grace, I'll find time to add simple questions before we go into hard questions so that you'll be able to understand it better. So I will look for maybe 2 or 3 questions that are very simple, basics, then before you go to because it's actually very simple and straightforward. There's no big deal there. So I'll take my time to explain it in the next class. Okay.
Okay. Thank you, sir.
Thank you very much for your time. So in the absence of any more comments, so I want to wish you all good night rest, and we shall meet on Monday by God's grace to solve questions. Thank you for your time. I remain myself, Ojo Izolo Atubilaba. Have a lovely night rest. Bye for now.